Yes, it's World Investor Week, and Mary Holm says there are 8 myths about investing. She joins us now in the Auckland studio. Hi, Mary.
Hi, Jesse.
Nice to see you.
Thank you. Yes, we haven't been in the same studio for a few weeks
I
now.
know, it's been a bit like that, hasn't it?
Yes,
Well, thank you for coming in, and you've been moonlighting. I understand you've written a bit of a guide to this.
Yeah, for the Financial Markets Authority. It's a little booklet thing on their website. It's about 20 pages long, something like that, with pictures. And it's looking at 8 basic things that people often get wrong about investing. So shall I just quickly read through that list?
Yes,
first?
please do.
Yeah. The first one is, I am not an investor. A lot of people think that if they've just got money in bank term deposits, they're not an investor. But in fact, I think they are. Anytime you're setting money aside and earning returns on it and hoping to get more money out the other end, I call you an investor. Second one is, KiwiSaver is not a real investment, and that's, a bit of a common attitude, but of course it is. Even if you're in a low-risk KiwiSaver fund, it is. Investing is too risky is the third one. And the quick answer to that is that there's a huge variation of risks you can take. I'm not rich enough to invest, and these days you can invest with very little money. You certainly don't need to be rich, and in fact, if you just set a little bit aside, even if it's $10 a week or something, if you do it over a long enough period, it can actually end up being a really big amount of money. The fifth one, real investors play the share market. In fact, as you and I have discussed before, a lot of the smartest investors don't play the share market. They choose a wide range of shares and get in there and hold them. And in fact, lots of research shows they do better than the people that are in and out trying to time the market, etc. Sixth one, investing is just too difficult and time-consuming. Well, it doesn't have to be. Quite apart from KiwiSaver, if you're doing stuff beyond KiwiSaver, you can there's plenty of help out there to do things pretty simply. I'm too old to start investing now. Never too old. 90, 95, why not? Yeah. In fact, I get letters from people sometimes who are well into their retirement who are still saving out of their New Zealand super. All they're living on is New Zealand super, and they're not spending it all. They're still saving in their old age, which is quite incredible. And finally, advice is too expensive. And financial advice is, you can get some really good stuff free, and also fairly cheaply. But I wanted today to just sort of zero in on the one that I think is perhaps the most interesting, which is that investing is too risky. And I decided to break investment risk up into 3 areas. The first one's probably not one that people think of immediately, but it is nonetheless a risk, and that is that you don't get the return you want because of inflation. So if you're earning these days pretty low interest in a bank term deposit, if inflation gets going and gets to be faster than, in fact, possibly at the moment it might even be faster than some bank term deposit interest, which hasn't been for a long time actually, but like decades, you've tended to be able to make more on your investment than inflation. But given that term deposit interest is so low, and so if you've got money in a term deposit earning 1.5% and inflation gets up to 2%, you're actually going backwards. You're taking the money out and it won't buy what it would have bought when you first put the money in. So that is something for people to be aware of. The second type of investment risk is that you don't get the return you want because of volatility, and that's obviously you want to get the money out at a certain point, and if it's not what you expected because the markets happen to be down, well, you're in trouble. And the third one, which is probably the most obvious sort of risk to people, is that you'll actually lose some or all of your money. Not just lose it because of a downturn, but lose it because someone's run off into the sunset with it, and through a scam or just terrible management, etc.
Or I suppose if you put it into one business and the business fell over.
Absolutely, yes. And of course, when it's your own business, which happens, a lot of people setting up their own businesses, and that's probably, I suspect, happening more at the moment because people are losing jobs and saying, perhaps they're a bit older and saying it's hard to get a job, and it can be really hard if you're over 50. So let's set up our own business, and that's great. That's terrific, and you know, undoubtedly we're going to get some super new businesses coming out of that. But at the same time, people quite often invest quite a lot of their savings into that, and sometimes get a mortgage or add to their mortgage to invest in their business. And as we all know, a lot of businesses don't do well. So just kind of have one eye on how you would cope if that sort of thing happened. But I don't want to discourage people because, you know, a lot of terrific stuff comes out of new businesses.
Thank goodness for entrepreneurs.
Absolutely, yes, indeed. But looking at each of those three types of risk, the risk of inflation, the answer to that is to get into riskier investments. Don't just put all your savings into say bank term deposits, because as I say, the inflation could be higher than that. But investments in shares, the long-term returns in shares and in property are always higher, well, nearly always. I mean, short-term, no. Well, short-term, sometimes shares and property go down, and meanwhile, inflation's chugging away. But over the long term, they always are higher than inflation. And so, you know, people, particularly often women, who put their money in conservative investments, conservative funds or bank term deposits, are actually running that risk of inflation overtaking the value of their savings. And so in some ways it's less risky putting some of your money in shares or at least a balanced fund that's partly in shares.
Yeah, it's an interesting way of thinking about it.
Yeah.
It's more risky to have all your funds in a low risk option.
Yeah, that's right. It's in fact, when we call it low risk, that's probably not a very good terminology. But it's sort of, we should say low volatility rather than low risk, but that volatility is a long word. Yeah. The second one, the risk of your investment turning out to be volatile and therefore you run short of money. There are several ways to reduce that risk. Don't have short-term money in high risk, which you and I have said so many times it's a broken record.
Yeah, if you're 60 years old and you're hoping to get your money out at 65, don't have it all in the share market, right?
Absolutely, yes, yeah. It's just.
Or if you're 35 and you're hoping to buy your first home in a few years, don't have it in a growth KiwiSaver fund.
Unless you're willing to postpone the house purchase if the markets go down. But so that's a fairly obvious way of reducing volatility risk is keeping the short-term money in a lower risk fund. Also, you know, if you're not used to volatility, try with a fairly small amount first. So when I'm encouraging people who are, because of the inflation stuff, to get into some higher risk stuff and they think, oh, don't know if I can cope, try it with, you know, 10 or 20% of your savings or something like that. Can really help people to cope with the market downturns. And then you've got to stay cool when the markets go down. We saw it earlier this year. We saw the quick recovery. As I said before, next time it might not recover so fast.
Yes. A good time to remind people that anyone who sold out of their KiwiSaver position when the market tanked after COVID-19 did the wrong thing because they lost all their money. And anyone who saved or who stayed in their KiwiSaver investment now will have their investment back where it began.
That's right. Yeah. And
you can't, that's Mary's main thing, is you can't try and time the market.
No.
You can't try and get out at the right time because it will often usually be the wrong time.
Yeah, yes. You're absolutely right. And the interesting thing is because it all happened within one calendar year, when we go back, you know, later on and look at what happened in the year 2020, you know, there's quite likely to be, you know, the higher risk funds went up not as much as they had lately, but they might have gone up 2 or 3% or something like that, and people won't realise unless they look at the monthly data what a dramatic downturn and recovery that was. And, you know, everybody's just got to keep remembering the next time the recovery might take quite a lot longer. Yeah, it was very unusual to recover so fast.
Here and in the US.
Yes. Absolutely, and in world markets in general, yes, yeah. And another point about volatility is never be forced to sell a volatile investment. So if you're in a share fund or a range of you buying your own individual shares, and hopefully you've got a range of them, or if you're in a property investment, a rental property or commercial building or something like that, just keep on watching out for what might happen to you that could mean you end up being forced to sell, because that's when people end up selling at a low price quite often. Because so often what forces you to sell is that you've lost your job or something like that, or there's been an economic downturn and your business is not making as much money. And those are the times when the value of the property or the shares might be down as well. It's just a common thing. Bad stuff happens to you, and then bad stuff happens to your investments at the same time, and you end up selling them when the market's down, so you're selling them at a low price, and that's horrible stuff. So just always, never be forced to sell is a really good rule to just keep in mind for whatever you're getting into. And then finally, the business about losing all your money because of a scam or deeply incompetent management or something like that. What you can do to mitigate that is, be aware that the Reserve Bank's watching banks, which doesn't mean a bank can't get in trouble, but they are regulated and they are monitored and
tested,
yes, they are, and at the moment anyway, it feels pretty unlikely that the banks that you're going to lose money you've got in a bank. Not impossible, but unlikely. And the Financial Markets Authority watches KiwiSaver and other managed funds, financial advisors, and so on. So, if you're sticking with mainstream sort of investments, the regulators are watching. No guarantees you won't lose money, but it's pretty unlikely. But watch out for the scams. So I'm just actually looking into one at the moment, a letter I got to my Herald column from somebody who almost certainly has been scammed, and it's horrible to read what's happened. And, someone's come along and said, hey, you can make big money doing this, and, this person has got tempted by it, and you just start looking in the background as to some of the names of the companies that have been involved and so on, and you just have to Google them, and up come warnings from Australian and New Zealand regulators, don't deal with this company, and I just think, I wish people would do that before they put their money in.
Another of Mary's great slogans, if it sounds too good to be true, it probably is.
Yeah. It's not only my slogan, it's everybody's, isn't it? But and it's so hackneyed. It's kind of like all your eggs in one basket. Some of these things are said so many times, they're just so boring. But really, if something does look too good to be true, it probably is. Yeah, it almost certainly is. So an important rule about this whole thing about investment risk is diversify. This is another one of the frequent messages. If you're into shares, own a lot of different shares. If you're into bonds, own a lot of different bonds. Or the easy way to do those is to be in a KiwiSaver or a non-KiwiSaver fund, which will spread your money out over a lot of different ones. Also diversify across different types of investments. So good to have some of your money in property, some in shares, some in bonds, etc. Also diversify internationally, because, single market can do really badly sometimes and really well other times. I've got this interesting table that I've got in my latest book, Rich Enough, and I also use it in seminars and that, where I look at the share markets around the world, the biggest share markets plus Australia and New Zealand, which one did best in each year, all the way back from the mid-80s right through, and which country did worst each year. And quite often, the one that did best one year did worse the next year, or the reverse. They cross over.
If someone says to you, hey, you've got to put your money into the Australian share market, look at it returned 23% last year.
Yep, absolutely. That might mean that next year it's going to make a loss. It might not, of course.
It won't necessarily mean anything.
No, exactly. But it can easily, because markets get overbought and then oversold. You know, people get this irrational exuberance, and everyone's getting into the market, and it pushes the prices way up. And then there's quite often a crash after that. And so you get these huge, big swings. And so it's really not a good idea to concentrate on any country, including New Zealand. Have some New Zealand investments by all means, because we've got sort of local interests in them, and you get dividend imputation, which is a tax advantage on New Zealand shares. But it's really a good idea to spread your money around the world. Get into, you know, the funds that do it for you. They a New Zealand run fund that's got an international investment puts you into shares all over the world, and that's by far the easiest way to do it.
We'll finish off there. I'll send listeners to the website for the Financial Management Authority, fma.govt.nz, where they can print out Mary's introductory guide for investors. And you've got a webinar coming out too?
Actually, I just did it about an hour ago.
No point in plugging that then.
No, but it's going to be on it was people's questions. It went really well for an hour, and on the Financial Markets Authority website, the FMA website, there's a link to you can watch that webinar. So
I've got a friend who works in funds management, and he told me an acronym. Is it an acronym or homonym? On the weekend I hadn't come across. Have you heard of TINA?
It's ringing a bell.
Yeah.
What is it?
It's a theory that everyone's putting their money into the share market at the moment because TINA, there is no alternative.
Oh, yeah. No, that's interesting,
and
isn't
it accounts for the
Yes.
success of the share market because no one can get any return anywhere else because of the low interest rates.
That's certainly a theory. It's a worry, though, because it's not a very good reason for shares prices to be pushed up where they are, probably. So just be careful, people. Don't put money in the share market that you can't leave there for quite a while.
Thanks so much, Mary.
It's a pleasure.
You can find today's chat and previous chats with Mary online, rnz.co.nz/Jessie.